services. The financial system operates through a whole bunch of tools, of exchanges, trading platforms, indices, ETFs on the back of indices. These are things that are critical parts of the architecture of transition and change. And that's why I'm so excited to get JP Morgan, friends of JP Morgan, onto the call today, who are going to be launching this very cleverly named, what can I say, Climate Bonds Index. There's a couple of things I need to mention to you. There's a Q&A. You can ask questions of Jarrad. If you're a customer, tell us, and we'll make sure Jarrad gets back to you straight afterwards on the app, the Q&A app panel. This will be recorded. This won't be in languages, this particular one. English only, short, sharp. The interpreters have insisted we give them a break. So we've given them a short break in languages at the moment. Otherwise, they're going to all collapse. But it will be available online. We're going to hear a short message from Jamie Dimon and some of his colleagues at JP Morgan in just a tick. But first, I need to introduce you, who you see on the screen, Jarrad Linzie, who's the Managing Director, Head of Index Research Product Development at JP Morgan. And he has been there a long time. He knows where all the bodies are buried. I don't think he's going to tell us about those bodies being buried today, but nevertheless, we'll see how he goes. Over to you, technical team, to play the video. One, two, three. It's coming.
Today, the world is facing a number of significant environmental, social, and governance challenges. As a global financial institution, JP Morgan Chase recognizes that our business decisions have the potential to impact the environment and surrounding communities. Climate change is one of the priorities we are addressing. We are growing our capabilities to help clients raise the capital they need to invest in projects and initiatives intended to achieve positive environmental and social outcomes. And we are calling for coordinated policy solutions that can help all of us effectively confront this threat. In 2020, we are aiming to facilitate $200 billion in financing to drive action on climate change and advance the objectives of the United Nations Sustainable Development Goals. There are numerous ESG initiatives the firm is undertaking, and we will continue to expand our commitment to sustainable business practices to better serve our clients, customers, employees, and our local communities. Thank you.
JP Morgan is proud to be one of the original co-authors of the Green Bond Principles and to continue to serve on its executive committee. We are pleased our involvement has given rise to the further development and expansion of the sustainable debt capital markets, including the social bond principles, sustainability bond guidelines, and the most recently, the sustainability-linked bond principles, providing the market best practice guidance. Our firm's approach to ESG has facilitated partnerships across various lines of business at JP Morgan, enabling us to better serve our issuer and investor clients.
Responsible investing is increasingly being integrated into our index business and in JP Morgan's research overall. We recognize there's an opportunity, but also a responsibility to better serve and support our clients as they advance in their own ESG capabilities. With this in mind, our index team launched the JP Morgan ESG suite of indices. It's designed to provide investors with a foundational framework to incorporate ESG discipline within their investment process, regardless of where they are in their ESG journey. Since the launch in 2018, the assets managed against the JP Morgan ESG indices have grown exponentially. Our latest addition to the ESG index lineup will be a Green Bond Index with the support of Climate Bonds Initiative. It will explicitly contain green bonds as determined by CBI. This index is unique in that it rewards certified green bonds that are aligned with the Paris Agreement of 2 degrees warming versus just general green bond issuances. And we believe this will help promote the transparency and vigor the green bond market needs to achieve scale. Thank you for your continued partnership and support for JP Morgan's global index research offerings, and we will continue to service you with more innovative products. Thank you.
Cool. Thank you very much, JP Morgan. Jarrad, not a bad Kickstarter. You're on mute, mate. Question to Jarrad. You need to unmute your button, Jarrad. Question to Jarrad. Tell us a little bit more about what's in it and what prompted it. I mean, of course, what I'm interested to know is your perceptions of market appetite and why now.
Yeah. So as Gloria, as Jamie, as everyone mentioned on the video, I would say that ESG is actually very important to us. And what we do is really service our clients, and our clients are actually very important. And part of our mission at the same time is really to build a framework or build tools that really hones in and provides a gauge on how fixed income is evolving. And that is green bonds. And I will be honest, I'll raise my hand and say guilty as charged, where this was brought up to us several years ago. And we always believe in order to move things forward, there needs to be a bit more standardization. That's how fixed income works. And we thought that we would actually figure out a way to integrate green bonds as opposed to creating a separate product. So I would say that the demand has always been there, right? But now you have multilaterals, the likes of AIIB or IFC, really pushing the agenda and pushing it in a very strong way. And I would tell you, back then when we were thinking about how to integrate green bonds, we looked at it very similar to how we looked at Sukuk type instruments in the past, where we wanted to create a bit more sponsorship and awareness. Why not just add them to standardized benchmarks to create the sponsorship necessary for them? And when we did that with Sukuk instruments, we basically created $10 billion of demand. And our thoughts, if we created a product that would be a standalone Sukuk only index, as an example, that the demand would probably be somewhere in the realm of 5 billion at most. And that's the mindset that we had when talking about green bonds as well. Why not integrate it into our ESG platform? Why not create standardization to help move this forward? But the reality is, green bonds have grown so much. I don't think anyone thought that green bonds would grow this much, to be quite honest. I'm not sure you thought it would grow that much, or this quickly.
Hey, we'll talk
at
about
the same
that.
time. Because the reality is, we are a shop. We're a research franchise that really builds tools for clients' awareness. And when you start to think about the debt stock of green bonds itself, right, it's bigger than European high yield credit that's been around for ages. Let's say,
yeah,
it's
amazing.
on par. It's on par in terms of size of the CLO market. All right, so that in itself will probably prompt you to say, maybe we should be focused on this. And not only that, but then if you look at the growth potential of green bonds, by 2022, you're probably at $1 trillion asset class, right? That in itself is something that you just can't ignore, especially if our jobs and our duty is to create tools to canvas and illustrate the evolution of fixed income in itself. So I think why now is because it is continuously evolving. We want to make sure we capture that for our client base. And not only that, but there are a lot of, let's call it, clients at the moment looking to create more products dedicated to such. And, the proof is in the pudding, where the debt stock is the debt stock and it's not decreasing, it's only increasing and looking to expand.
Yeah. So massive growth. Jarrad, sorry, I always had confidence about this. Always confidence. But hey, at the end of the day, I'm not an investor. I'm not a banker. I'm just a pundit. So I can do that sort of stuff. We're about $1 trillion outstanding now, if you include the Chinese.
Yeah. So
but of course,
we try not
to.
So we're not including China and then securitized, right? Because China is another interesting thing to discuss, and we need to figure out how to move that forward, because there's a lot of accounts that's looking at China, but China is just opening its market up, but also these bonds need to also be rated. So there's a lot of, let's call it, Chinese local issues that don't have ratings to them, and that will also hinder a lot of the managers to actually own them in their own respective portfolios.
And I want our Chinese listeners on the call to note that. So what we're going to need to do to get capital to flow into China, where there are yield opportunities now, which just don't exist in other countries in the green space, is we're going to need to play by the international rules. It's not going to work to just play by the Chinese rules to get access. And there's work we're doing. Let's see if we can make this work for JP Morgan in the future. But tell us a little bit about the actual index itself, what makes it unique. Give us some color and flavor here.
Yeah. So, I mean, the index itself is, we're going to provide two variations of the product. Of course, we're going to provide a straight market cap weighted approach, which is not going to be dissimilar to what already exists in the market itself, to be quite honest. But I would say that our brand as a franchise has always been about diversification. And I'll tell you that, you know, historically, everything, you know, in fixed income has always been about market cap weighted. And I'll touch on one of the most frequently used, let's call it developed market rates products out there. And when you start to really peel it back and see what's in it, and you look at US Treasuries, JGBs, Eurozone, and you say, well, JGBs and Eurozone actually make up 90% of the overall negative yielding debt supply that's out there, right? And then if you factor in US Treasuries and say, well, if you factor inflation at the same time, all of US Treasuries is basically negative yielding, right? So when you have a product that's, let's call it 90% of the benchmark, there's nearly $3 trillion managed to that, but it's all negative yielding, that doesn't really help in terms of the overall capital preservation of a product, right? So, I mean, we don't believe in straight market cap weighted products. We don't believe in just overweighting issuers because of their debt supply or how indebted they truly are. You know, so we wanted to create something that's a bit more diversified. So again, we'll have a market cap weighted product, but at the same time, this one will be a little bit different because we feel that all green bonds are not alike. We feel that we need to, our strategy moving forward is around ESG. So we want to factor in ESG integration into this product itself. When we start to peel back and look at the index itself, I mean, roughly, let's call it 40% of the index would have an ESG score that's above 80. And on the opposite end of the spectrum, only 5% of the index will have a score that's below 40, right? So it just shows you how different the issuers tend to be. Half of the index itself is corporate bonds, right? You know, again, all green bonds are not alike. And not only that, but then, you know, we have, as Gloria mentioned and earlier, you know, we have something that we wanted to kind of showcase and promote a bit more is the certified green bonds, right? You know, and again,
what got you there? I mean, I'm keen, but tell me your thinking at your end.
Because again, I mean, the whole idea of green bonds is to promote good, right? And that's something what we really want to do, right? And there's different levels of green out there, right? And what are those levels? I think this is where it comes to educating individuals for the most part. But, you know, I would kind of ask you the question because we're using your data, we're using you, and I think it would be very important for individuals to get a better understanding of certified green bonds. How do you see that evolving in the market itself? Do you see more issuers looking to tap in and see how they can be or get that stamp of approval? You know, are they just looking to be green or are they looking to be certified? How is that changing in the market? Because look, you know, at the end of the day, we do want to promote issuers to really think about their strategy and do good. But I would ask you the question, and maybe you could provide a little bit more insight on certified green bonds and the evolution and where you see it moving forward.
Good point. Well, I mean, essentially, it's a kind of gold label. I think I was on a panel recently with the Deputy General Manager of the State Bank of India, and he was saying that in their investment portfolio in India, if they see a certified bond that ticks the green credential for them, they move on to the other issues and they have a bias towards them because they know there's a review and governance structure behind it and a bit of a story behind it. And that's what we hear from investors around the world. The only real difference between the certification and the rest of the green bonds, and there are a lot of good green bonds out there, don't get me wrong, it's the governance mechanism. So when someone does an independent review, it then gets reviewed by our certification team and more to the point, the certification standards board, which is made up of institutional investor reps from around the world.
Mm-hmm.
And that adds a second layer of review. And then secondly, there's a very clear standards taxonomy of qualifying investments with a long and tortuous story behind them of how we arrive at understanding what are investments in the transport sector, let's say, which are consistent to meet the Paris Climate Change Agreement. So we put out a hurdle rate, a threshold there. And so that you can be sure that there's really substantial work that's been done to ensure Paris alignment. Now, of course, that's been taken up by the Chinese regulators, I should say, and now the EU taxonomy. We've been working closely with the EU taxonomy in the last couple of years to get that out. So certification will start becoming confirmation to the EU taxonomy going forward as well. Now, it's not the only thing in the market, and I'm going to say some of the second opinion providers do fantastic work in this space. I have to commend their work. It's just this is easier because you know that it's linked to a whole structure of providing. Whereas the second opinion providers, they're essentially bespoke reports, and you've got to engage the report to understand the level of it. So that's the idea. You know, in bond markets, like most markets, commoditization helps. So this is about commoditization of quality. Yeah,
makes sense. Okay, great.
So, but a question to you, I guess, in terms of going back to the investor appetite, and you've been shopping this around and so on. What's your view about growth and expect? You're looking at a family of indices. Where are you going with this? How important is this in terms of the next steps of development? I kind of want to know how excited I can get about the JP Morgan pipeline.
So, look, we don't believe, I mean, the reality is moving forward, all of the products that we're looking to create, well, the majority of the products, right? Because there is data hurdles and things of that nature when it comes to ESG itself, but it is everything around ESG, right? So when we start to think about green bonds, this is only phase one of it, right? Because now you have, let's call it social bonds. Now you have, you know, things that's going to be aligned to SDGs, et cetera, right? So, I mean, the index should actually evolve. But of course, I mean, it's important in order to get the data necessary, right? You know, I mean, for us, we're index providers and we're integrating data and we're also helping making change. But it's important that we're able to partner with the right providers to give us the insight, right? Because we're not going to be able to do exactly what you're doing per se, but it's our jobs to figure out ways to integrate this and tell the story. And not only that, but at the end of the day, really tell the story to issuers, right? I mean, one of the pillars of this whole ESG mission is engagement, right? And engaging in the issuers itself. And look, historically, the G has always been very important from an investor standpoint, right? And now the E is taking off, and now you're going to start seeing the S take off a little bit more as well. So we think that there will be a transition, you know, to more than just green bonds per se. And this index will actually grow. There's no doubt in my mind. And you got me. I'm a believer now. You know, I definitely wasn't, but now I am a believer, and I do see this from different aspects, you know, and like I said, you do get multilaterals in Asia, you get multilaterals in the States, you get a lot of asset owners in Europe, all pushing the same or very similar agenda. Now, of course, standardization might be a little bit different, you know, from region to region, but there is a massive push for this. And when it comes at such a high level, you know, when it goes into regulatory, you got to expect that the asset class itself is going to be, well, maybe it becomes an asset class in itself, you know, to be quite honest, right? You know, as opposed to looking at corporates separately from sovereigns or supranationals from EM and DM, you know, so maybe it just does become its own asset class. But look, I mean, there is demand across the board.
That's a question I didn't really answer but Esther Law has just asked a question on the app. She's from CDL in Singapore. You probably know her.
Yes, I know her very well.
About the difficulty in expanding definition and certification of non-green ESG bonds. I want to answer the first part of it. On the green space, the areas where we will see expansion, it's not just growth in market against existing rules, which is going up. And while we had a dip in the first half of this year, for reasons we kind of all know about, it's really taking off again this month. We're also seeing an expansion of criteria. So in the next session after this, we'll be talking about resilience and recovery bonds as being part of the climate universe, and that will lead into certification over time. So Jarrad, that'll help your universe, if you like. Transition bonds, of course, what this whole conference is about, is an extension of that. And that will eventually get to looking at the portfolios of a whole company based on its transition plan and offering certification for that. And then, of course, there's adaptation issues. We've already seen some adaptation bonds. The Netherlands sovereign bond, for example, is primarily allocated to adaptation. That's going to be a big area going forward. So that's one area of expansion. So Esther's asking about, are we going to go into non-green ESG bonds, or where's that going in terms of the JP Morgan index? Or business, I should say.
Non-green bonds. I mean, look, there's always going to be for now anyway, right? There are a lot of asset managers out there that will basically say, moving forward, we're only going to create ESG products, right? That's it. We're only going to deliver ESG products because, I mean, we've already demystified the notion that you need to give up any yield to be ESG aligned. We see that. And to be quite honest, I mean, when we start to think about green bonds, look, there is no, I know everyone talks about what's the differences between a green bond and valuation versus a non-green bond and valuation. There's really no difference in the sense that at the end of the day, you all wait on the same line. They're pari passu to each other. However, I will say that there tends to be a bit more sponsorship for some of these green bonds. So you do tend to see them trade inside your conventional bonds itself. And also interesting enough, when we're looking at the index and the data behind the indices themselves, is that the volatility tends to be a bit lower on the green bonds. So when you start to look at the overall Sharpe ratios, you start to see, oh, wow, there is value from a Sharpe perspective. But when you think about valuation from end to end, where investors are holding things more and more to maturity, I would say the valuation is roughly is the same, right? Because none is senior to the other or whatever have you. But there are some anecdotes that we found quite interesting when we looked at the index product, the green bond product itself, is that one, we only have 5 years of data. Fine. We started the index with 20 billion in size 5 years ago. Now we're approaching 400 billion, which is pretty impressive. Two, everyone always compare performance. I mean, it's not fair to compare performance right now. That's not the right thing to do, because you're comparing apples to oranges effectively when you think about performance. Because at the end of the day, there isn't enough issuers to look at green bonds in the investment grade credit space versus your standardized products. They're going to look different. If you look at it from a race perspective, they're going to look different, right? So comparing true performance like for like is just not there yet. So I wouldn't touch on the performance bit as opposed to seeing how things are evolving, right? I mean, in our index, we're starting to see the Eurozone debt, right? Right now, it's starting to make up 30% of the overall index, and it's continuing to grow. As you mentioned, Germany yesterday, you mentioned that Germany is issuing a green bond, right? And that in itself is just showing you how much demand there is, or how much support there is, by some of these sovereigns itself. And then, I would also say that when we think about the product and the attribution of the product itself, 85% of the product is developed markets, okay? Because you look at a lot of these sovereigns like a France or a Germany, they can issue in very big sizes. But 40% of the index is from EM issuers, which shows you that 40% are EM issuers. Wow. Right? So there's 200 issuers in the product itself across 40 countries, but it just shows you that, the breadth of the green bond environment and how it's actually, starting to kind of be integrated in multi-strategies and not just in the developed market space. Now, look, from a size perspective, you can't expect EM to issue like a developed market issuer. That's just not going to happen. But it just shows you how much they're engaged and they want to do something a little bit different themselves. So, I mean, green bond versus non-green bond will still have standard benchmarks, but we do believe right now our ESG products are approaching $20 billion in AUM. We do believe that's going to continue to grow. We do believe that, you know, the issuers that are not aligned to ESG will start to suffer in terms of financing, you know, if they're not ESG aligned, when it gets to $100 billion of dedicated AUM, but it's a matter of when and not if. And I think everyone is on board, and JP Morgan as a whole, as you can see, Jamie was happily to do it. He actually did the video in one day. The next day, Gloria asked him and he said, sure, I'll do it. I'll do it tomorrow, take it, done. Right. So it just shows you the push for this, I would say, across our institution.
That's pretty amazing. Okay, I need to ask you a very simple question to finish up about comparison of all the other green bond indices. Just for everyone to take away, why choose this one over the others?
Mm-hmm. I think this one, so we'll have the standard that everyone uses that or that most already exists, but I think this one will provide more diversification. This one will provide a bit more insight on not only just the larger issuers, but not only that, it's more ESG aligned. It's not just looking at green bonds and that's it and call it a day. So I think this product would be more aligned to what regulatory is looking at, more aligned to philosophies internally at, you know, institutions, because I bet, you know, within, you know, our client base, they're not going to say that all green bonds are alike. So we want to make sure to make that distinction that they're not alike and how to treat them separately.
Fantastic, Jarrad. We need to wrap up already. Okay. We could talk for a couple of hours about this.
I know. We could continue talking. We're both talking. There's no doubt about that.
That was a good last word. Any last words that I haven't given you a chance to say?
No, I think that's about it, unless there's a question that may be asked or...
I've been weaving them in as we go. Okay. Gotcha, so I think we're okay for the moment. I think the key point for everyone on the call to know is that you can go to the JP Morgan Index booth in the Wover app and get a whole lot of information, and more to the point, make contact with the team if you're interested in finding out more. We at Client Bonds are extremely enthusiastic about this for the reasons you've heard a little while. We're cheering on its success. We think this is, apart from the fact that it reflects our values and our approach, more to the point, it's actually about, JP Morgan, particularly when it comes to emerging market indices, is the granddaddy of indices in that area. Everyone follows. Getting them to produce a product in this area is like a milestone in the market from our perspective. Essentially, especially one of such high quality as the approach Jarrad's been taking. So we need this, right? This is what we need to make the market grow. This is what we need to build bridges between the money and where the money has to be, which is transitioning our societies to low carbon, climate resilient, sustainable economies fast. So thank you, Jarrad. Thanks for joining us today.
Thanks for having me. Appreciate it.
Look forward to success. We're going to have to get you back next year to talk about the incredible success of the index.
And hopefully in person. Hopefully in person.
Indeed, hopefully in person. So folks, we've got another session coming up in a few minutes. It's about transition to resilience and recovery and what that looks like and what it needs to look like going forward. After that bonus feature, there is a investor panel looking at the implications for the market. And then I come back afterwards to give you a little bit of an overview of 10 steps for the next 10 years to wrap up. It's on your program. If you haven't seen it, it just went on your program. So it's a bonus feature. I want to say at Climate Bonds, we are very keen to support people who want to act in this market. We have a partnership program. JP Morgan Indices have become a partner. We're really thrilled about that. We do supply data. You've heard a little bit about that today. We supply it to fund managers. We supply it to banks. We supply it to all sorts of actors. We also do training. If you want to find out about Green Bond, or rather get your internal team up, we will do internal skills and training development to make it go forward. And we do certification. There's a whole certification apparatus around behind us, which of course feeds into the JP Morgan universe. So much to do, so many exciting opportunities. Thanks for joining us at this fantastic session. See you in 15 minutes for the next session.
Thank you.
Bye, Jarrad.